Hey guys, thanks for tuning in. We're going to talk about the recent Fed decision to raise rates, that they're going to do that again, what that means to you if you're buying a home. And I believe that the housing market is going to cool off. My last video, I talked about 3 factors of why. One of them is that buyers are cooling off. Raising interest rates are causing that. We're seeing a dramatic reduction in mortgage applications for primary housing. And let's dive right in.
Guys, thank you all for comments and questions on our videos, and I'm going to address one of those right now. We had a question, what about the interest rate increase? Can't buy less than 3% APR anymore. The question is how does that affect buyers and the affordability?
Yeah, I'm going to show you right now, guys, because what I had said was that I thought that the market was going to cool off. We see that here locally in Maryland. I'm not a financial advisor. I'm a real estate broker here in Maryland. And I always say that it's important that, the real estate industry, whether you're an agent or a broker, that you need to keep your thumb on the pulse really nationally, because it's part of our job. So let's go ahead and dive in and let's talk about what happens when interest rates go up. What I'd like to do is talk about this slide that goes over interest rates that really predates 1975. We want to take a look at where we've been through history. So if we look back here, and we'll kind of start backwards, but for the last 10 years, we've really hovered anywhere from about 3.5% to 5% mortgage interest rates. But if we go back beyond that for 7 years, okay, really from 2002 to 2009, our average mortgage interest rates were about 5.25% to about 7.25%. And if we go back even before that, another 10 years, from 1991 to about 2002, we averaged about 6.75% to 9% in 30-year mortgage rates. Now, guys, we can quickly take a look back pre-1975, and you can see where I've drawn this little bar here, but we hovered right around the 7 to 8% mortgage interest rates. That was back pre-1975. So what we're seeing happening right now is really, it's not unusual at all. But a lot of people are thinking, that we're going to experience the 1980s interest rates where it got up into double digits and almost, 20%, where it got to like 18%. I like to try and be a little bit more optimistic than to think that. But I think that we have to keep it in the perspective that I honestly believe that we're not going back to 2.75%, which was really an outlier rate. But I think that we're going to probably get somewhere around 7 to 7.5% very quickly. And the Fed just announced that they're raising rates 50 basis points, which is 0.5%. And a lot of people think that this is directly affecting mortgage rates, and that's really not what they're talking about, okay? However, it is going to affect mortgage rates, and it's going to affect every rate.
Yeah.
So ultimately, it's going to affect your credit card rate. Hopefully, it's going to affect savings accounts rates that people, maybe they'll encourage people to put a little cash in the bank. I can remember growing up, getting 7% on my savings account and really watching it grow. I'm not trying to say that, guys, but I do want to talk about what happens to your payment, and hopefully with us seeing a little bit of cool down in home sale prices. All right, guys, so here on this board, we have 2 different columns of prices. I'm going to explain that right now. But the most important thing is that we're going to talk about the list price. Okay, we know that the median house price has gone up quite a bit, but we're going to use, for the purpose of this analogy, we're going to use a $380,000 list price on a house. What we have seen lately is about an average of 10% over list price as far as the sale price. And we found that in this price point, most of the time, the house will still appraise. So that means that if you have a house that is listed for $380,000, you're going to offer them, okay, another $38,000 over that price, which is going to give us a contract price of $418,000. Now, based on a 5% down payment, okay, which is the bulk of the loans have been conventional, and a lot of the buyers have had cash for this. So based on a 5% down payment, that meant that the borrower is putting down $20,900 plus their other closing costs. But we're just talking about the down payment for the house, the purchase price of the house. That gave us a financed amount of $397,100 at a 5.5% rate. Now, I'm not even going back to where it was 2 3/4 because we know that is gone. I believe it's gone, and we don't even need to talk about it. But let's talk about the rates lately. On an average of 5.5%, that meant that your monthly principal and interest payment is $2,254. Now, guys, I want to just make you aware that this does not include, because I don't know where you live, it does not include any mortgage insurance for putting less than 20% down. There's a mortgage insurance that goes on top of that based on your credit, things like that. It also does not count your homeowner's insurance, because that varies where you live, and also your real estate taxes, because it also varies depending upon where you live. And we're just talking about the numbers on the loan from the purchase price of your home. Now let's go ahead and jump over to what I am hopeful for is more of a buyer's market. So let's take that same $380,000 list price, but now in this case, the market's cooled off, and let's say that you're able to negotiate a $10,000 reduction in price. And by the way, guys, we are starting to see that here in Maryland. Not every market is experiencing it. Many markets are, and I think that this will kind of normalize, because that has been normal to real estate in the history of time. That $10,000 may come off of inspections, various different things, maybe a seller contribution in some cases, but let's just say that we're going to take it as a direct savings from the purchase price of the house. That gives us now a contract amount of $370,000. It changes your 5% down, in this case, to $18,500, giving you a financed amount for the loan of $351,500. Now, guys, let's say that those interest rates jack up to 7.5%. That is going to change your principal and interest payment $2,457 a month, or an added cost of $203 a month. So let's just continue with this analogy. What we have done here from one scenario to the next is we've actually saved $48,000 on the initial price that you paid for the house. The $38,000 over asking price, the $10,000 savings now equals $48,000 less if this market turns the way that I believe that it will. And basically, you've changed your down payment. You've saved $2,400. You had to put down $20,900 in this case, $18,500 in this case. That saved you $2,400, which equals, guys, a total savings of $50,400. Now, guys, if you take this additional payment and you divide that by the $50,400 that you saved in this scenario, that says that it will take 20 years for you to pay that amount of money, right? I'm going to put it another way for you. If I said to you today that I would give you a loan for $50,400, and I said that you could pay me back in 20 years without any interest at all, and you would just pay $203 a month, would you take it? I think that you would. So, Melissa, this is what I have to say about the comments that are saying, and they're very valid comments. I appreciate them, but guys, we have to do the math.
And Todd, I think I just want to mention that we were spoiled, and I don't want to say this in a negative way. I just think it's overall, when you get used to something and you get used to having a lower rate, when we were in the 2.75, I think that we were spoiled as a whole. And now looking at it through your chart that you just did, it's really not that bad at all.
Well, I think the important thing is that the low interest rates were one of the fueling factors as why the prices were able to escalate. And I think the Fed made a big mistake by not pumping the brakes last year.
We've talked about it too long. It went on for too long. And now the result is we are where we are.
So guys, I think that the raising of the interest rates, though they will affect a lot of people, but I think that if you were prepared to buy, before all of this, right? And the only reason that you couldn't buy was that you couldn't afford the $38,000 over list price, the $50,000 over list price, because maybe it wouldn't appraise, or maybe that starting number was too unrealistic. I think that if it's you, but you still have your down payment money, hold on to your cash. I think you're going to be able to find the deals. Be patient. Things are going to turn around for the good. I'm an optimist. I like to think that way. Thank you for watching this video. If you like it, give it a thumbs up. It'll let us know that you do. And guys, if you want to hear more about real estate, go ahead and subscribe to our channel. Hit that bell. You'll find out when we post new content.
Keep those comments and questions coming. We love reading them. We love responding to them.
See you soon.
See you next time.
Sachs Realty, Maryland broker number